Penny stocks are among the most volatile classes of investments. Pretty much everyone interested in this area already knows that, but it bears repeating for those who may just be getting into them. Their risk implies both quick gains and quick losses. The old maxim of investing only what you can afford to lose holds doubly true here. Let's check out 10 hot penny stocks to buy now. Number 10. UpHealth Incorporated, UPH. UpHealth is a digital healthcare services company. The company went public via a special purpose acquisition company, or SPAC, and totally botched the process. UpHealth quickly missed expectations and then raised capital at a sharply discounted share price, leading to absolute carnage for the stock. Down more than 75% of the original SPAC offering price, however, UpHealth may be primed for a comeback. For one thing, shares are now selling for less than 4 times the revenue. That's not bad for a company that guided 50% revenue growth for next year. The company is already profitable on an EBITDA basis. The market may continue to punish UpHealth for being an SPAC that disappointed shareholders right out of the gate. If and when that changes, however, the stock could rally sharply. Number 9. Sundial Growers Incorporated, SNDL. Sundial Growers is a Canadian marijuana firm. The company originally started out trying to dominate the cannabis market, but its efforts failed amid a brutally competitive playing field that was plagued by drastic amounts of excess inventory. SNDL stock nearly went to zero, but it became a Reddit and social media favorite and surged in early 2021. This allowed the company to issue tons of stock, paying off all its debt and ending up with more than $1 billion of excess cash. The company is now reinvesting those funds into new businesses such as retail cannabis and liquor stores and a financial arm to lend money to other marijuana firms. Sundial's new strategy seems reasonable and has a decent shot at success. The market, however, is still unimpressed, leaving shares at just 55 cents today. That could change as Sundial's new investments start to pay off. Number 8. Up Fintech Holding Ltd, TIGR. Up Fintech is a major retail brokerage operation for the Chinese marketplace. The stock went public in 2019, but didn't do much for quite a while. In 2020, however, Up Fintech enjoyed a massive surge in activity and share price performance. Like in the US, overseas brokerage firms enjoyed a boom in activity as people were stuck at home and turned to the markets as a new hobby and way of making money. TIGR stock soared from $6 to the $30 mark at one point. Since then, the stock has crashed. Chinese regulators have cracked down on numerous domestic companies, and US investors are shunning virtually all Chinese stocks. Up Fintech continues to grow revenue by more than 40% per year and is selling for just 13 times the estimated 2022 earnings. The company also counts Interactive Brokers Group Incorporated, IBKR, among its strategic investors, giving it significant credibility outside of China. Number 7. Taseko Mines Limited, TGB. Taseko Mines Limited, TGB, is a developer and explorer in the copper space. Copper is looking especially interesting right now because, despite some recent weakness, prices are up so far in 2022, from a 4.45 average versus $2.80 in 2020. This is on the back of the weaker US dollar and tighter global supply. Copper is also used in the electric vehicles and infrastructure spaces, both of which are set to grow substantially over the next decade. Finally, the recent election of a new leader for Chile, based partly on his promise to halt a large copper mining project in the country, suggests that companies will soon be looking elsewhere for their copper. Taseko Mines operates in Canada and the US, meaning it's unlikely to deal with some of the problems Chilean copper players are currently facing. Most promisingly, Taseko finally had the draft EPA permit come through on its Florence copper mine, with the final permit expected to come through in 2022 and operations set to begin in 2023 to 2024. Number 6. Paysafe Ltd, PSFE. Paysafe is a leading payments company focused on online applications such as eCash, digital wallets, and online gaming. The company went public via an SPAC merger and has suffered the same sort of treatment as most other fintech companies over the past 6 months. At $4, however, the stock looks compelling. For one thing, insiders, including both company management and the backers of the SPAC, bought more stock in the open market. For another, shares are trading slightly below the enterprise value at which the company had previously been acquired back in 2017. Additionally, Paysafe's 2029 bonds continue to trade at 94 cents on the dollar, indicating a high degree of confidence in the company's long-term financial prospects, even with the stock price having dropped sharply. As the SPAC overhang lifts, Paysafe should rally in 2022. Number 5. MoneyLion Incorporated, ML. MoneyLion is another busted SPAC opportunity. The company is a fintech operation primarily located in Southeast Asia. MoneyLion already has a sizable business. It reported 2.7 million customers in the third quarter of 2021, which was half of a million customers from the second quarter of the year. Over time, MoneyLion is planning a land and expand approach where it continues to grow its active user base while cross-selling more individual products to each existing customer. New areas of growth will include cryptocurrency and buy now, pay later services. MoneyLion isn't yet profitable, and in current market conditions, investors aren't giving unprofitability any benefit of the doubt. At less than 2 times its projected 2023 revenues, however, MoneyLion shares are certainly cheap enough as long as management continues to execute on the business plan. Number 4. New Gold Incorporated, NGD. Unlike Western Copper and Gold, New Gold is already a gold-producing mid-tier mining operation. The company has mines in Canada and Mexico. New Gold is slated to be highly profitable. Shares trade for around 7 times the 2022 projected earnings. On an enterprise value to earnings before interest, taxes, depreciation, and amortization basis, shares go for less than 5 multipliers. This is an attractively priced stock. The stumbling block is the price of gold, which has leveled off around $1,800 per ounce over the past year. That's down from the $2,100 peak the element reached in 2020. With the Federal Reserve planning to raise interest rates aggressively, it puts a damper on the outlook for precious metals. However, if anything forces the Fed to back down, or if inflation continues running ahead of expectations, gold mining shares such as New Gold could surge. Number 3. Ambev SA, ABEV. Ambev, a leading Brazilian brewing company, is an outlier among the top cheap stocks, boasting a $43 billion valuation. The company operates as a regional arm of global beer giant Anheuser-Busch InBev SA. Unlike many penny stocks, Ambev has no financial difficulties or major structural problems. In fact, it has a debt-free balance sheet, trades at a low price earnings multiplier, and offers investors a healthy dividend. Shares have declined, however, due to factors outside of the company's control. These include an unsettled political situation and soaring inflation in Brazil. Both of these issues should clear up in 2022. Brazil has elections this year, which will provide certainty to the political situation. Number 2. ContextLogic Incorporated, WISH. ContextLogic is an e-commerce company that operates the Wish shopping app. Wish appeared to be taking the market by storm in 2020 as it enjoyed a massive pandemic-related boost. Wish's model includes a so-called treasure hunt, where users buy unexpected or unusual products at unbelievably cheap price points. In 2021, however, the company ran into issues. Many shoppers complained of low-quality merchandise that quickly broke. Meanwhile, the company's customer acquisition model broke down. As the economy reopened, advertisers such as Meta Platforms Incorporated (FB) raised prices, making it unprofitable for Wish to continue marketing on digital platforms as it did before. Number 1. Western Copper and Gold Corporation, WRN. The last among the best cheap stocks to buy under $5 is Western Copper and Gold, a Canadian mining firm focused on its casino project in the Yukon province. The company counts Rio Tinto plc among its strategic backers. It also offers shareholders a strong balance sheet as the company is debt-free. The company is progressing towards developing the mine and expects to give investors an updated feasibility study later this year. The project consists of 41% copper and 38% gold, along with smaller amounts of silver. As far as gold is concerned, Casino hosts more than 14 million ounces of measured and indicated reserve. Western shares surged from $1.20 to $2.80 last year as copper prices hit multi-year highs. There's been a dip in copper and gold lately, hitting Western share price. With inflation on the prowl, however, demand may come roaring back for this sort of asset. Do let us know in the comments which one of these would you like to buy. Please subscribe to the Stock Advisor. Thanks for watching.